Hey everybody. Welcome to week 291. Hey, guess what? That means that we're only 9 weeks away from the 300th week anniversary. Yeah, we're excited about that. Put that on your calendar. April 23rd, the Hamilton. Wheels Up recording starts at 11 like we normally do, or sometimes it's 11:01. But I think we're starting at like 9:30 or something like that. Maybe 10. I don't remember. I'll have to look at the invite, but we're gonna have food, breakfast burritos and stuff like that, I think. So anyway, it's always fun, always a good group of people. But we've got a special guest today. We got Keith Taylor. Do not ask him about pickleball. Do not ask him about pickleball. Because it'll just completely train wreck the whole thing. He's a pickleball fanatic and aficionado. So just so you know. But and Jorge's on and his Fireflies note takers on. That's a good thing. So anyway, before we toss the ball over to Keith, by the way, you're looking quite dapper there, Keith. I feel
Trying to keep
very
up with this group,
underdressed.
Gary.
It's always good. So, uh, Jack, Adam, any thoughts that you guys have? Things that we need to riff on before we let Keith do what he needs to do. And make sure you leave at least 20 minutes for Keith to do his
Yeah,
financial disclaimer.
yeah, no worries. So it's always interesting at this point. Like I never thought that I'd reach the point in my professional career when I'd say that I'd known people for decades. Yet that's where I'm quickly approaching with Keith. So no, 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 and he hasn't aged a bit, or it could be a Zoom filter, either way. But the only, it's funny. It's the tirade is the government shutdown on um, DHS, and and it's not necessarily about that in particular. Versus again, just reminding everybody, like I don't know where the right amount of taxes are to pay, or like what's the right tax rate to pay. But I do remember when I was running for the Huntersville Town Commission, and I lost spectacularly in that race. Um, but and it was because I wouldn't say some stuff like, Keith, we're spending way too much money in this town. I'm gonna be in there counting paper clips and blah 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 blah, and we're really gonna get this budget under control. And if you look at the Huntersville town budget is you know, like non-police, non-fire, not, in other words, like everything that's not first responders, you know, or like sanitation is like 5% of the Huntersville town budget. So
Wow.
like you just weren't gonna move the needle at all. And what it reminds me of is that in other words, like what were you going to do? And if you couldn't in the same breath say we need to pay our police and fire more, but I want to cut the property taxes. Like it's just disingenuous to say that. And at the same time, North Carolina hasn't passed a budget either. And what's really funny about North Carolina not passing a budget is, Jack, you might say it's because we can't get a bipartisan agreement. It's a Republican controlled House and Senate. like, like
Barely.
they can't even agree.
Barely.
But that's not it. It's like they can't even agree,
Yeah.
amongst themselves on the balance between a tax rate cut and like wanting to pay. In other words, like in the same breath, they're like, Jack, we need to cut, taxes. I want to see this tax cut. By the way, we need to pay our teachers more. Like at some point there has to just accept the fact that both things can't mutually exist in the same world. So that's a long way of saying, hey, we got, got a midterm election coming up. Who knows what's going to happen? But Adam's prediction is more nonpartisan or whatever it is, gridlock.
Yeah, yeah. I think gridlock is in the
Yeah,
future.
gridlock in the future because you can't even get parties to agree amongst themselves, let alone with each other. And North Carolina is like exhibit exhibit A, of that. So anyway, and how it affects us is like what it also means is that they can't really have any real discussion around how to change anything in North Carolina with respect to the One Big Beautiful Bill Act in terms of like, will we conform or will we not conform? So it's caused us a lot of frustration here at BGW.
Well, what's interesting is that you also when you talk about tolerance and what is our tolerance generally as a society, and I think that it shifts. So when you have a 43-day shutdown in recent history, anything less than that is like, okay, well, and does it really impact us directly, these little short-term stoppages of the government? I mean, they do indirectly, but have any of us really seen a significant impact in what we do on a daily basis necessarily because of these things? Now, having the discussion today as we talk about, financial planning and things like that, yes, of course, those things are going to have potentially an impact, maybe short term, medium term impact on our investments and things like that. But it seems to be that our tolerance for these types of things, these disruptions in our lives, seems to get higher and higher because we have tolerated worse. And we're like, okay, what I mean, that's what I see is that, okay, well, it's happening again. And the fact that no one's in Washington at this point, at least officially, because they've been out since I think last week or the week before. They're not coming back until next week officially. Now, as we know, there's a lot of stuff going on behind the scenes. And there are people inside that Capitol building working very hard to figure things out and negotiate and everything else. But at least officially, they're not talking to each other. And I was listening to a very interesting podcast about the history of politics and how and this is way off on a tangent, but since we're talking about Washington D.C., is that back in the mid '80s or so, prior to that, people who were members of Congress actually moved to Washington D.C. and raised their families there and had this interaction because they had to. So they were friendly to each other at night and on the weekends when they're going to school events. But then that eroded away and they started living primarily in their respective districts and then coming to work into DC and seeing how that has eroded this level of cooperation, at least civility, maybe kind of thing. So just there's so many things that go on behind the scenes outside of core politics and positions. So anyway, way off on a tangent, but anyway.
That's a great point. I mean, that is a great point. It's easy to be a keyboard flamethrower, under an anonymous account or whatever. Uh, I don't do that, by the way, but I know people that do. But it's a whole lot different than when you are behind somebody at a grocery store or you're sitting next to them at a concert or whatever. It's a very different thing. Or you're at a pickleball tournament and you're playing against them. It's completely
That's
different.
true. I think from a community perspective, Jack, per your history podcast, politicians used to only go work 2 or 4 year terms, leave their jobs, go to DC. They only
Yeah,
had a short amount of time to get work done, so they were more maybe compromising with their fellow politicians to get things done because they only had a short amount of time to do it. Now, till there's term limits, they could be in there for decades,
right. As we've seen.
unfortunately.
Oh man. So one of our big objectives for today is to make sure that we don't have Keith in compliance trouble with the compliance police. So that's an important thing. How we've avoided that at Shoemaker for Jack for us is, you know, uh, less of a deal. But for you guys, like we're really trying to keep you out of trouble. But we do want to talk about this notion of compliance, or not compliance, but diversification risk or lack thereof, especially when it comes to business owners. You know, we've all done this, where we believe in it. We have to get something airborne. We put everything into it, our heart, soul, sometimes our 401k, whatever. We bet all in. Or if you're working for a company and you're buying all the stock that you can, if you're in a publicly traded company, or you're doing whatever you can to just like keep pouring it in. And I've done that many times and gotten burned by doing it. But then what? Like, uh-oh, what do we do? And especially in planning for, all right, when there is a transition of power, you're going to take some chips off the table. Maybe you take all the chips off the table. You know, there's all kinds of things that come into play besides even the money part. But I'd kind of like to focus on the money part and even some of the psychological and emotional things that go through that. I think it'd be a good discussion, because all of those things are things that, or a lot of them, people don't think about until they get there. And then it's like, now what? So I think this would be kind of an interesting discussion. Anybody listening on here, watching, if you got questions, hit us in the Q&A, or if you want to just completely avoid my instructions as you have for 6 years, just put it in the chat,
And,
So either way, we'll monitor it.
and Gary, if I could add a topical layer to that, and I also want Keith to introduce himself because we all know he has street cred, and I've known Keith for also a long period of time. Many years ago, trusted him when we were both younger to guide my family, appropriately and appropriately for our age, and that has evolved over the course of time. So one of the things that I wanted us to touch on, and one of the things that we had discussed internally was that we've seemed to focus purposefully on business owners and what's right in front of them, or maybe in front of them 3 to 5 years down the road,
Yeah.
and kind of assuming that they will figure out, that we will all figure out things, or that we have people that are guiding us for the longer term. So what I wanted to do was to maybe shift the focus to maybe longer range planning, but to what you said as far as putting stuff in and just doing it, the assumption that you're doing the right thing for yourself and for your family, for your business, for your employees, because it was what you've always been doing. And so not taking a look back, we've suggested many times on this program that you need to take a pause and look at what you have going on. And just because it was good enough last year or in prior years, that doesn't mean that it's good or what you should be doing in present or moving forward. And so now focusing more on the far future as to maybe some presumptions that we make as business owners that we should think about doing differently as well. So adding that topical layer to what Gary just described as well. So,
Yeah, and
yeah, go
I
ahead.
I'll make a comment on what you said, Jack, because there's a big distinction, right? You as an individual or family looks at your finances different than if you're a business owner. When you're a business owner, it's all about the business all the time. It's your
Yeah.
passion, it's your baby, it is nonstop. And then when you have more employees, you've got to take care of your employees. And the next thing you know, 3, 5, 10 years go by and you get used to that, but you haven't done anything for your future per se. You've grown the business, hopefully. But I think it's a very big distinction when you're a business owner versus a W-2. And you guys have all experienced that as well. So I think
Yeah.
that mindset is very different from their perspective,
Yeah.
right? So as an individual, like you said, you're thinking about every day, you're thinking about monthly and vacation and this and that. As a business owner, you're like, oh, well, I'll have the business pay for it. I'll have these certain deductions. But that transition, like you guys know the stats better than I do, right? But however, as a business owner, what's the percentage? Like only less than 25% actually sell their business or something like that. And so you get complacent, not complacent, you get used to the fact that you are a business owner in that habit. And then all of a sudden you're 55, 60, thinking about retirement, wondering what you do next. And there's a lot to pull into that. If they don't have the right advisors, like the people on this podcast today around them,
Yeah.
unfortunately, they're not in a great position when that time comes.
All right,
Yeah.
so a brief pause. Tell us, tell us about you, Keith. And understand and understand that this is we don't promote people, we don't promote businesses. And what's interesting is you have a limitation of what you can say anyway, about yourself. So we don't even have to self-police that. But I think it's appropriate to I'm happy to do it, but if you would
Yeah.
introduce yourself into the group.
Yeah, I've been in the financial industry, right, for 26 years now, plenty of certifications and licenses behind my names, working with individuals, families, business owners for this time. And, over that time period, working with such a diverse group of people, I would say one of my specialties is Gary sort of mentioned this, is the psychology behind money. And there's a whole
Yeah.
study around this called behavioral finance, which I tend to study a lot because I think that money is not it's obviously not tangible, but there's emotions around money. And a lot of times we don't always realize it, right? I sort of relate it to exercise. Like we all want to be in good shape, and we all understand we have to eat less and move more to be in better shape. And you might do that Monday through Friday, but by the time Friday night comes and you just want a beer and pizza, you sort of the whole week sort of out the window. And I tend to relate that a lot to money. People know what they should be doing, but they either don't understand how to do it or they just don't put it into practice. So I'll leave it at that for now.
I'm I'm curious, like I want you to go a little bit deeper on this notion of behavioral finance. Like
Yeah,
that's
so
the first time I heard that.
it's interesting. There's tons of books on this. I'll give you a couple if you want, but I will tell you that it's interesting. I'll just talk about the United States, right? Like we don't realize it, but financial institutions sort of know behavioral finance than better than anybody because they want our money. They want it on a monthly or weekly basis. And then when we want it, they want to give it back to us as slow as possible.
Yeah.
I mean, we are as a society, we are taught to spend money, right? How many of us can just go on our phone and press a button and we have something delivered tomorrow? But
Right.
we don't have a conscious effort to think about it. It just happens. We don't deal with the consequences until 30 days later when we get a credit card bill, right?
Right.
So, no, we will not go back to this point, but early in my career, I would advise people if they had spending issues to only use cash. So think about
Yeah.
this, Gary. When you have cash, there's a couple things that need to happen emotionally. One, you have to physically go get cash. You either have to go to the bank or you have to, get the money somehow from your house. When you pick up that dollar or $20 and give it to somebody, there's a physical reaction your body has that you've worked hard for this money and now you've got to give it to somebody. So
Yeah.
there's all these emotions that happen when you actually spend cash. Plus, you've got a limited amount in the bank, so you're limited as well.
Right.
That's changed. Obviously, we all know it. You press a button,
Yeah.
you swipe your card or phone, and it's done. And there's no emotional feeling at all related to that.
Yeah, can I add, I'm going to add
Wow.
two things to that. First of all, Keith has been a very good financial psychologist for me over the years. So he listens very well when I call him up and say, and he hates it when I tell the story, but it's a variation of the
I do
story.
hate it. So,
I know, I'm gonna tell it anyway. in a different way. So that, when I'm at the car dealership and I call them up and say, I really would like to buy this car, and then I'm justifying it. It's a used car, great mileage, everything else. And then he just listens and then ultimately allows me to make the decision because I've thought it through. The other is I also want to give Keith credit. So when we were back talking about during COVID times and PPP loans and everything else. And then even afterwards, the concept of having availability of cash or liquidity in your business came from Keith because he many years ago said, "Do you have a personal home equity line?" And I'm like, "No, why would I need that?" And he said, "Well, maybe you might someday, or maybe someday you might want to use it, or use it as an emergency backup to having cash and having to hoard cash." So that when we were discussing that on this program many years ago, that's Keith Taylor original as far as setting up a business line of credit when you don't necessarily need it, but you have it as financial security. So there you go.
Yeah. Gary, there's
Yeah.
lots of ways the behavioral finance comes into each of our lives, right? When we make financial decisions. And as a business owner, there's just more decisions to make. Um,
Yeah.
I think you find that, like I said before, logically, we might understand this concept of how money works or how we want to apply it. But emotionally, we just want things, right? Like using Jack's example, if somebody wants a car, we might look at their financial balance sheet and see that they really shouldn't buy one yet because they've got to create more debt. They don't have enough assets or cash for that matter.
Yeah.
But you know what? I work hard every week and I really don't want to drive this 10-year-old car around, even though it goes from point A to B. So they can, in their head, make it make sense and they feel better
Yeah.
sleeping at night. But from a financial standpoint, it's not always the best answer.
Yeah, Keith, on that note, my I love it when our clients graduate to even bigger problems called help me justify the plane. But yeah, the
Right.
and I always say the same thing. I'm like, well, of course you can deduct it, and that will pay for a year's worth of the plane payments, but you can't make this make financial sense. But how, we all we all sort of deal with, at the one end of the spectrum, you've got the person who uses the Jack rationalization and justification, which either shows up as either A, but Keith, I can't take it with me, or B, um, but Keith, if I put that dollar to work in my business, I can generate a 20%, 30% return, whereas the best you're going to do is, 8, 10, whatever, right? So it's like, I'll get a better return in the business if I reinvest the dollar here versus there. Yeah, that's kind of one end of the spectrum. The other end of the spectrum is I'm living in fear and I'm retirement poor. You
That's
know,
right.
how do you, I guess, what do you say to, what do you say to people, that kind of at either end of those spectrums?
Yeah, it's a very interesting concept, and this is the part that fascinates me because what you'll find is our mindset, each of our mindsets around money comes from the first 20 years we lived most of the time, right?
Yeah.
I'll give you an example. We don't know as many of these people as we used to, but people that lived through the Depression, you probably go around their house and they have envelopes full of cash because they never had cash growing up and they needed access to it. So they hoarded cash. That was their mindset growing up. They didn't have anything. Um, I think we all have stories that we've gone through around money. Gary's mentioned his businesses, many successful, some not as much, and all of our clients that have businesses, right? When you go through an experience when you're younger, or even I went through an experience in my 20s that was not fun, and it shapes your experience around money, whether you are a spender or a saver, right? When we talk to clients, we usually fall into one category. It's the same as a business owner. You have that same mindset, whatever that is around money. In fact, interesting side note is that when you look at married couples, you will find that one is usually a saver and one is usually a spender. Very rare do you find two spenders, and when you do, they don't always last very long because
Yeah.
there's not enough to go around, right? And so to your point, Adam, that mindset around money we have from our experiences, and that shapes the way um, that we act. So, an example, there are some people that have lost a parent young, or certain health conditions have prevented them to do the things they want, and they have that mindset where life is short. I'm spending what I have now. A lot of people in our industry don't always think and go into peel the onion back to understand why people feel that way. But
Yeah.
when they do, it's easier to make financial decisions individually or as a business owner because now you understand the reasoning and now you can apply it in a different light.
Yeah, I got you. Yeah, so I think the the hard part is, well, actually, I'll tell you what we've always used, Keith. I'd be curious to get your opinion on this. It's like you can kind of use your mortgage payment as your proxy for everything. Like, what's your cost of living? And it's like, okay, if I've got it, if I just follow Dave Ramsey or whatever it is, just pick one. It doesn't matter. But if I've got a $2,000 mortgage payment, then I should be able to live off of 100 grand, call it. And as long as I'm there, I should be good. If I still feel broke above that, that's because I've got the spending money like a drunken sailor problem, you know. But if I'm not there yet, I should consider not beating myself up, too much. What do you think about like that as an approach? Like, how do you tell people about like you know, Keith, I'm broke and I'm worried about my retirement. They pull up in a Ferrari.
So there's tons of people that you can hire to help you with your finances, individual or
Yeah.
business owners, right? One of the reasons why I think I have a lot of clients that trust my opinion is because I'm pretty blunt. I don't cut around the edges. I pretty much tell you how it is. And if you're that type of person, this is why we figure out if we're a good fit from the beginning. There's a number of sort of high level rules that I try to stick with, right? Like what percentage of your income should go to a mortgage per your comment, or how much you should pay yourself first to an investment, whatever investments you decide to put into, um, and what your monthly cash flow should look like. People don't always like hearing it, but the reason they hire me is they want that accountability. They either care too much about their business, their family, they don't have the time, energy, or expertise, and they just want somebody to keep them accountable and somebody that they trust to do that. I know that sounds so plain vanilla, but it's the people that know better that don't want the advice because that means they have to change their spending habits if you follow that logic.
Yeah.
Yeah, no, that's right. Yeah, no, it's hey, I'll just make some more money, but it's amazing how the money has a way of never being enough, and the spending habits always catch up to it.
Right. I'll use the analogy again about your health, right? People know they need to stay in good shape so they can be around for their grandkids, but they keep eating fast food and pizza and too much overdoing it on libations, and they don't make any changes. As much as people tell them, as much as they look in the mirror, they don't make a change until they're in the doctor's office after having a heart attack, and the doctor's like, you got to make changes. Well, scares the crap out of them. So guess what? Hopefully most people make those changes because they've experienced such a negative impact on their life and world, and it became more real. With money, it
Yeah.
doesn't always become real until, like Gary mentioned earlier, until you're closer to retirement and you try to sell your or exit your business or whatever it may be. We all need that holy crap moment to experience that to be able to make meaningful changes in regards to your money and your habits.
So, Keith, let's say that I'm asking for a friend.
Of
Um,
course.
yeah, so you know, prototypical small business BGW client, got 20 employees, on paper the company's doing really good, but I don't get to take all that cash home, I still got to pay taxes and stuff like that. And, you know, at at best, I may be funding my 401k plan. Like that's the best that I'm doing right now. And I've only been doing that, for the last couple of years, and I'm 40 some odd years old. What would you say, hey, here are the top 1 to 2 things you need to do? I know every circumstance is different, but if you say like one or two general pieces of advice that if I'm that guy, I'm kind of banking on the future. I know I'm probably being irresponsible. I need to do something. What would you what are the things that you would suggest that I do to start to build that liquidity portion, of what I ultimately need?
You just mentioned like 10 things, so it's hard to put it in one, but
Yeah.
let me give you a high level. One of the things I was going to mention at retirement, but it impacts us during our working years, that I think is the number one factor, right? Especially in our industry, people talk about a product or a strategy or some deductions or something, real estate, own this or that, that's going to make you financially successful. And we all know that's not true. However, the one concept that I fall back on, whether you make 100,000 or whether you make $3 million, is owning your cash flow. Number one, you have to understand money in, money out, which sounds easy, but as a business owner, especially, there's lots of variables in there. And then understanding what you actually bring in versus what you spend. Those are two different concepts, right? Like what we spend every month is what we've been talking about. And spending also could be investing. So where does our money go? Where do we spend it? And if you know, like I have these different concepts and narratives, like people should be paying themselves first when they get a paycheck. And when you pay yourself first, you understand there's money going to you or your family or your goals and objectives. But what happens, Adam, is normally people pay all these expenses and maybe there's something left over at the end that they can do something with. And it's backwards. And it goes back to that same mental framework of the money. So to answer your question, owning your cash flow and understanding it, I think is the number one takeaway at any point in your life. Now, at retirement, I know this whole thing's about business owners and retirement, but at retirement, it's even more exponentially important because you've got a limited amount of assets, yet you feel entitled to work in so many decades that you want to spend and do all these things. And if you haven't done a good job to that point, it's not going to be pretty.
I was going to reiterate that, Keith, because that is the challenge, which is in the psychology of it, which is that you're entitled to it because you've worked hard. For me in my 50s, been a partner, and so maintaining that financial discipline as you have just described, which you've instilled in us, which is okay, pay yourself first, which is difficult sometimes because at the end there is no fun money left over. And so similarly, with business owners, you feel entitled to, and maybe you have increased your standard of living and, gotten that boat or do whatever it is. And then you're like, okay, wait a minute. Maybe not the right thing or at the right time, or you don't want to let go of certain things and modify your standard of living to be adjusted to what is your reality in front of you. For example, this little thing called COVID, how we all had to change some things in our lives in order to survive, to get through that period of time.
So I want to interject real quickly because you brought up a four-letter word called boat. And Joseph says, well, what about boat deductions? What's the threshold to meet or dedicate or depreciate that as a business asset? Adam, you want to address that one?
And Joe, when are
So,
we going on your boat after
yeah,
that?
yeah, exactly. So, with the boat, as I'm going through the rationalization and justification, you basically have two flavors. One flavor would be it truly is a charter boat. That's totally fine, in terms of like, hey, I really charter it out. Like of course that'd be a deduction. No different than I, can deduct my VRBO, behaves the same way. The other end of the spectrum is I've got a boat on my dock at my house on Lake Norman. Is there a way for me to deduct that? The answer to that is ish. Like what you can do in that scenario is if you're taking them, like Keith, come on over, we're gonna have a great time, go out on the boat, talk about our partnership together. I could deduct, pretty much up to the fair market value of what would it cost to rent that boat, as a expense reimbursement to myself. We actually have a YouTube video on this. If you check out the BGW YouTube channel. But that's about it. So it's like, okay, if I've got, $200,000 Air Nautique, am I going to get a deduction for $200,000 Air Nautique? Probably. It's ridiculous how much those cost now, by the way.
It
Um,
is.
am I going to get a $200,000 deduction for an Air Nautique? No, but it costs 2,000 bucks a day to rent that boat. Could I at least reimburse myself for, a couple months worth of boat payments when I added up? you know, and still pass an audit, sure. I could probably pull that off. But getting back to Keith's point, at some point I have to evaluate, did I really need the $250,000 aeronautique in the first place? Like in other words, I needed that. It's funny, like I need to not then cry poor mouth to Keith and about how things are so stressful and I'm so worried if I'm out, buying that. At the same time, I do recall a funny story from one of my when I my grandfather was a business owner and then his next door neighbor, Les Ebert, was a business owner. And Les always had the toys, motorcycles, classic cars, every year bought a brand new car. And I remember one time I just asked him like, why do you do that and how do you afford that? Like generally I'm like, God, because I want to be like Les. And he said, every time I feel like I needed to be motivated to work harder and sell more, I just bought something new.
That's actually a true statement. Especially people in sales,
Yeah,
they
Yeah.
need the motivation. So they go buy it and then they give them a reason why to work harder, right? It's
yeah,
crazy.
exactly. Like I thought about that. I'm like, it actually made a lot of sense. It's like I bought something, now I got to pay for it. It means I need to get my ass out there.
Hey, before we leave the boat real quick, does it make any difference the fact that it's in Tennessee?
Nope.
All
Yeah.
right. I just wanted to address what you're asking for a friend there, Joseph.
Yep.
I think he was inviting us to Tennessee
Hmm.
and
Yep.
in that
Oh,
comment. So
okay.
yeah, yeah, okay. You had mentioned in the beginning, and we went off on a different tangent in the conversation about concentration risk, and with business owners, and not necessarily financial concentration risk, but we've also talked about as far as customers, clients concentration, as far as supply chain and those kind of things. But what in relation to financial concentration and how business owners are investing for the future. So kind of if I were to look at a 30-year range, in 10-year increments, the first 10 years being building it up, the middle 10 years being protecting it, and the last 10 years being your exit strategy and what you're going to do next. Focusing on that middle section, what would be things like concentration risk or other things that you see many business owners not realizing that they are tripping over those issues, and because they're just doing what they've been doing for the first 10 years and not addressing that middle phase of wealth aggregation.
Well, that's actually an interesting point because I think you all will agree that there's an art to owning a business, which is the first 2 to 4 years, you're just hoping you survive and you got to
Yeah.
build the business. You've got to hire employees. You've got to figure it all out. And what you started doing in the beginning after 5 years may not be your role in the fifth year, depending on the type of business you do. However, because the business is usually the number one thing in your life after family, and that's where you focus and spend all your time, a lot of people don't change after 5 or 10 or 15 years. They keep doing the same thing. They may adjust their business in different ways, based on the economy and their product or sales or whatever. However, I think their financial habits, right? Those are harder to change in the middle, to your point, the second decade, because of what they're used to. Now, they may meet with their accountant and they say, hey, do this retirement plan and get these deductions, or there may be other opportunities. I don't know if there's a lot of change. To the point about concentration and what Adam mentioned earlier, I agree that most business owners, successful ones, the best rate of return they're going to receive is in their business. So then they wonder, why do I have to allocate assets outside of my business? But they're not looking at the purpose of those dollars. They're just looking at a rate of return. Does that make sense? And so that's not necessarily a good answer, but again, it's a behavioral one that they feel like my return is better, so I don't want it sitting around. But there needs to be, this is another concept, Gary, as a takeaway, is every dollar we each have needs to have a purpose. And people don't think about it this way. A lot of people say, like you mentioned earlier, Jack, everybody needs to have some amount of cash reserves, whatever your number is, whether it's 10,000 or 100,000, whatever that number is. But a lot of people also don't like having money sit in the bank because maybe it doesn't earn a good return. I don't disagree with that. However, the purpose of that money is not necessarily a rate of return. It's to be there in case of an emergency or something happens to the business, individual, etc. When people start to look at it from a different lens, which does take time, it starts to make a lot more sense. What they have to do at that point is understand and prioritize their objectives and what they want, and then align their money to go in the same place. What you'll normally find is money will go somewhere that doesn't always align with their objectives because it just needs to, or that's what they've done for some amount of time.
Mm. Yeah, this is going in a very interesting direction, which mindset matters in everything. In everything. It's like, but how often do we not take a pause and go, well, why? This goes back to the power of Simon Sinek. Are you asking the question why? Why are you doing this? Very powerful. I want to interject one more thing. So, comment came in here, hypothetical situation where you sell your business to a family member at an agreed upon valuation. Then you finance the entire purchase with the promissory note that's payable when the company sells. Okay. Then let's say that the family member wants to negotiate or renegotiate uh, the amount based on their view of your importance about the current value. Jump ball, and if there's additional clarification that's needed on that, I'd be curious as to anybody's comments on that.
So from my perspective, when you have business owners, and this is happens all the time, it is what is your perspective, your introspective as to your value to the business in relation to the value of other people to the business. And then when you have generational differences, meaning in age, and have different objectives. So this goes well into, okay, what are, and we've talked about this before, is knowing what your business partners, what their objectives are, which even if you're the same age, that it needs to be, there needs to be a lot of discussion and a lot of rowing in the same direction. And when those things start diverging, then that needs to be acknowledged and dealt with. And a lot of times what happens is that doesn't get dealt with until down the road when there is a disagreement. So for example, in this hypothetical, okay, what is the relative value of this individual, and at the time of the negotiated, whatever the underlying transaction was, and then over the course of time, there's a perspective that, okay, was that and now kind of answering the question more specifically, at the time that this arrangement was made, was it a recognition of the current value that was brought to the business and that was what was being compensated, or was it based determined upon the value of the business down the road? And maybe if that's exceeded, then should that person be entitled to that value? So again, not knowing more about that particular scenario, but understanding kind of what's going on in the background, I believe. It's just, that's why it's one of those things where you put it down on paper, you sign it. This is the obligation. This is how much is owed to a seller. And if you want some ambiguity, throw in an earn out in there. That's a great way to do it. If you're okay with ambiguity, because many times you're not going to get the money out of an earn out, or at least as much as you thought you would.
Yeah,
That's
this is a pretty tough one because like what sorry, were you done, Jack? Sorry, I didn't mean to interrupt you. So the if you just take a black and white view of, you know, earnings were $100 when I took over, and now they're 1,000. You can make the case, well, I was responsible for the 900, therefore, I created it, you did not create it, upon that change. But the couple things that you bump into on that is that, first off, that's really undervaluing the expert in it, kind of what went into the experimentation to even have it be at the point where the extra 900 get created in the first place. Like, in other words, the extra 900 only exists because the 100 existed, and all that stuff that happened at the initial inception. Now, at the same time, like, if I'm going to Jack to navigate a partnership dispute, and it's like, well, this thing's valuable and we're still reinvesting. We've been in business for 20 years and haven't made a dime. Like, at some point, I have to say, is it really? you know. But if I'm truly looking at like the progression of a business, and I mean, the second source that you have for that is if you just look at like who makes the most money in a private equity deal, it's the early most of the time it's actually the early stage investor. Because that's
Yeah.
when
Highest
that
risk.
that's when there was the highest risk associated with it. So like the multiple that someone gets at that early, like the appreciation that someone gets at that early stage because they took the risk, is radically different from the person who came in at a late stage when the bet, like, it's still risky, but the bet was somewhat, guaranteed. So, and oftentimes it's the difference between like, you know, $1 invested equals, a 10 times return over a couple years versus $1 invested equals a 20-25% return, based on a late stage investment. And for Keith's FINRA recording, remember that was me promising a guarantee, not Keith.
Thank you.
So, so I think, I think when I see scenarios like this, it's a lot of times like people don't necessarily people don't necessarily remember all the work that went into it's a combination of like either people don't recognize the work that went into the very beginning, or alternatively, if I was there in the beginning and then somebody took the ball and ran with it, um, they don't really they don't appreciate the value that the next person that really killed it, knocked it out of the park did. And a good example of that in the other direction, they didn't really um, they're not having to have a renegotiation, but one of our clients just became an ESOP this year. And when the owner that's there now, that is the principal owner in the ESOP, who's a couple years younger than me, when he started with the company and became an owner, the company, it's a construction company, the company was at $25 million in revenue and it just clocked at 400. But the founder of the company left due to health reasons in the third year of the owner now's ownership. So like, yes, there was some startup stuff, but it's like you kind of can't argue with the fact 25 million, 400 million.
Yeah.
Like at some point it's like, I mean, I get it. At the same time, it's like 400 million. Like that's a lot. So it's a hard question that can get pretty emotional.
So I want to go into this. So, and this is hot off the heels of a recording that Adam and I just did for one of his episodes of the No Hype Real Results podcast to be released in a bit. But we were talking about the emotions that happen with between partners, and we've all experienced that if you've had one. It's all going to be great until all of a sudden somebody feels like they're slighted, there's some inequity, there's an injustice or whatever. And we talked about the importance of having a neutral third party in the ring to just help navigate it because people avoid hard conversations because they don't want the fireworks, or some people enjoy the fireworks, but I think by and large most people don't really want it. But there's a huge benefit if you can have a neutral third party try to bring some common sense into this thing. And sometimes people are just so inflamed that you can't back them off, and out of the grate. But, you know, Keith, have you experienced anything like that where you can say, yeah, it was dicey. We were able to come in and just cooler heads prevailed, whether it was you or somebody else, to be able to come in and help kind of referee a situation?
Yeah, I feel like that's my main job, quite honestly, right? Like like people think what I do, like they used to have those old memes. What people think that I do is, work on investments and rate of return and all that. But what I actually do is I'm more of a counselor or coach for clients, right? And so
Yeah.
when it comes down to it, I honestly think making money is the easiest part. That is not hard. That is time and money you put away. It is the week to week, month to month concept where people need that accountability. They need that, quite honestly, they need the education to understand, like I said before, how do I get to what I want if I am here now? What are the steps to get there? Whether that want is a boat or a plane or paying for kids' college or whatever it is.
Yeah.
If it was easy, we'd all be doing it ourselves. We'd all be financially successful, but we understand it's not. And so that's why, the way I structured my practice and the philosophy I have, that's sort of where it came from. Because I don't want to be like everybody else. I want to make sure people understand and they need that person that they trust next to them. It's the same reason why all you three are so critical to your clients' lives because we look out for the client's best interest first. And we try to be on their side and on their team to make sure we get them exactly what they want.
And I'll
Hopefully that
add
answered your question, Gary.
Yeah, that's good.
and I'll add to that part of the difficulty in the psychology is when, if you are doing what you're supposed to be doing, which is paying yourself first, meaning funding the investments and everything else, or either personally or for your business, that when you borrow against yourself, which is usually okay, except in one important circumstance, do not borrow that payroll money that you've collected on behalf of the federal
Ooh.
government ever, because it sometimes becomes difficult to pay yourself back. And I think that what, and because of, again, the financial discipline that's been instilled with us with Keith is that, if, and I have that pocket of cash that I hold on to, but when I have to pull from it, that's the first place, that's where the money goes back to make sure that I have that amount versus, it's easier to say, well, I'll just reduce. I don't need that much cash in there as reserve, so I'll just reduce it to whatever current value it is, and that will be my new number that is my emergency money account. So it's those kind of things also. So in relation to business owners, when you have to borrow from yourself to pay for an unexpected expense, then just be mindful that, where did you pull that money from, and should you replenish that money back before you go and spend on something
That's
else, like a new computer or something else.
Yeah, let me make one more comment. I know we're probably getting close to time. However, one of the topics of this conversation was how do business owners transfer in retirement? And should they have money only in their business or should it be outside of the business? And what I find is because business owners are fairly successful, they keep investing in their business and that there are not as many assets outside the business. Back to Jack's example, it's definitely not in the first decade, maybe in the second or hopefully in their 50s. Um, I think that this is definitely overlooked, that the business owners think they're going to sell their business for X amount of money in the future, and that's where their retirement's going to come from. And while that does happen sometimes, we all know that's not always the case. And if they don't create assets outside of the business, their options are limited. And the one thing I know in this world related to money is you want to have options and flexibility because we don't know what's going to happen in this world, whether it's the economy, whether it is our personal lives and health, or something in regards to our business and income. And so creating assets, yes, it may be a retirement plan in their business, but it could also be other assets that help them transition to retirement in the future. If and when they do sell their business, that will only be additional monies that they have more options. I do think, and you guys tell me your experience, I wish more business owners would do this earlier to give them time to grow rather than only on the business.
Yeah.
Yeah, no, I think we'd agree. I think that I it indirectly it's kind of like the hey, don't leave, too much money sitting in the company, because it imposes a risk. I think to your point, Keith, if you thought about pay myself first, right, and translated that into a typical business owner perspective, this is a piece of advice that we haven't actually given to business owners, but I'm going to start thinking about doing it. Like, because our version of that is, hey, don't get surprised by the tax liability. Like, you need to be saving for your taxes, right? So, since a lot of our clients are all sales oriented, it's easy just to translate that into like for every dollar in sales, you need to be putting 5 cents into your tax savings account. Well, you could sort of take the same logic and say, for every dollar in sales that you're taking, 5 cents goes in the tax savings account, 5 cents goes in the savings account.
You could
Like
definitely do that.
and
I would
just
increase
say
those
pay yourself.
numbers. Yeah, same concept. I would increase the numbers, but yes, it's exactly the same point. Would
Yeah.
do you think business, from your perspective, do you think business owners would push back on that?
No, because the ones that take it seriously, it's always one of my favorite things to say, hey, here's your estimated tax payment that's due. And I'm kind of dreading it because I know that it's a lot. And they're like, yeah, we got plenty of savings for that based on the advice that you gave us when you told us to set up these accounts. I'm like, so then I look like a hero, Keith, because like
Right.
they saved 300 grand, but I told them they only had to pay 200. All of a sudden, I'm like, man, you're the greatest guy on the planet. I'm like, well, I was kind of conservative, but I told you to save. So
Yeah, but I think as you continue to advise your business owners
yeah,
to do that and have
yeah,
more, they're going to listen to what you say.
yeah,
And they don't know any different. So if you say put this money here and this money there, they may not be used to it, but coming from
yeah,
you and they hire you and pay you money, that they're going to listen to you. Otherwise, why are they paying you money?
yep,
Right?
that's
For
right.
your
Yeah.
services.
Yeah, this is good. Any final like pickleball recommendations you got there, Keith?
Yeah, just make sure you don't never exercise and then go play pickleball the first time. It's the number one leading cause of injuries in the hospitals these days.
That's what I heard. It's crazy.
Yes,
Yeah,
it's because it's fun and it's social. It could be competitive, of course, but if you're not healthy, you're not active, and then you go run on a court in these directions your body's not used to, that's when those injuries occur. So Got to be
Yeah.
careful about that.
Great
Chiropractors and
advice.
surgeons are happy about it. Insurance
Yeah,
Yeah.
companies are not
that's
happy
right.
about it.
That's right.
True.
All right, guys. We're going to be putting this thing up on the BGW YouTube channel later on today. Shoemaker is going to be doing the same. Keith, thank you so much. Always good to see you.
Yeah, thank you for
Uh,
the opportunity.
yeah,
Yeah.
this was really good. Thank you, Jack and Adam. You guys have a great rest of the week. And hopefully, Joseph gets back to Tennessee and gets on that boat this weekend.
All right.
See you
See you
guys.
Take
guys.
Thank
care.
you.
All right.
Bye.
Thanks, Gary.
See you, buddy.
All right.
Appreciate you.
Yeah, man. Hey, and you should definitely, I know you came out last year, but we're doing that March Madness thing again, March 20th. So if